By going through this PowerPoint, you will arrive at next lesson with a firm understanding of what variable, fixed and total costs are, as well as the difference between revenue and profit and the importance of price. During next lesson, I will test your understanding of costs, revenue and profit, and whether you can calculate costs, revenues and profit, as well as potentially analyse the relationship between costs, revenue, price and profit. Remember these key definitions to gain knowledge marks on your exam questions. We will now look at two different types of costs a business will face. These are fixed costs and variable costs. Fixed costs do not change in relation to output. Okay, so some examples of fixed costs. Think of costs that a business will have to pay regardless of how much they are producing or providing. Rent will still have to be paid. Insurance. Electricity bills. Staff that are paid salaries will still have to be paid. These costs do not change in relation to output, so they are what we call fixed costs. If we were to draw fixed costs on a graph, they would be drawn in a straight line like the example on your screen. The output, even though it's changing from 1 to 7, the cost of the fixed costs does not alter because these have to be paid regardless. This is the opposite with variable costs. These costs change in relation to output. Okay, so can you think of some examples of variable costs? Let's use the example of a burger restaurant. If a burger restaurant sells more burgers, then think what it needs to buy more of. It will need to obviously buy more meat for the burgers. It might need to buy onions, bread, sauces, etc. These are all costs that will change depending on how many burgers the business sells. So therefore, these are examples of variable costs. On a graph, fixed costs were drawn as a straight line because those costs stay the same regardless of output. However, we now know that variable costs change dependent on the output. So on a graph, this is shown by a sloping curve. The more units we produce, the greater the variable cost. As business studies students, you will be expected to calculate total costs. In order to calculate total costs, all you need to do is fixed costs plus variable costs. So if fixed costs were £500 and variable costs at your maximum output were £600, then your total costs would be £1,100. We will now have a look at what revenue is. Revenue is the income a business receives in return for the sale of goods or providing a service. In order to calculate revenue, we just multiply the selling price by the quantity sold. So, if I sell my products at £5 average price, and I sell 10 that day, then my total revenue for the day will be £50. Revenue does not deduct any cost. It is simply the income a business receives in return for sale of goods or provision of service. Have a go at the following 3 questions. Can you calculate the sales revenue for each of the 3 businesses? So now that we have an understanding of costs and of revenue, then that allows us to work out and understand what profit is. So profit is a comparison between costs and revenues. If our revenue exceeds our costs, then we will make a profit. If our revenue is less than our costs, then we are making a loss. To calculate profit, all we do is total revenue minus total costs. Remember, in an exam, you may have to calculate the fixed costs and the variable costs individually, add these up, and then deduct from the total revenue figure. Have a go at the example below. Profit was £1,400 per week. Did you manage to calculate the correct amount? Use a case study you have been given on a separate sheet of paper to complete this independent task.